What's up everybody, Gen X Dividend Investor here. In this valuable video I tell you what retirement is like for people who own dividend stocks versus those that don't. And if you appreciate when I do free dividend investing videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and then select all notifications so you're notified the next time I post a video. To kick this off, let's first understand what retirement currently looks like so we can better appreciate the power of dividend income. And to do that, we can look at the US Census Bureau report that examined the income sources of households in the US that have at least one person who is aged 65 or older, and whose income pays for most of the rent, mortgage, and utility costs. Results were broken down by household income into 10 deciles. The bottom 10% of households brought in less than or equal to $12,640 a year of income from all sources. The next 10% brought in between $12,000 and $18,000 of annual income. Then if we skip a couple deciles, we see that the households in the middle range of income, i.e. in the 5th and 6th deciles, made between $29,000 of income a year on the low end to almost $42,000 of income on the high end. Or to guesstimate things, I'd say that the average retiree household income was about $35,000 a year. Note, this survey was done about 7 years ago, so with inflation I'd guess that the amounts would be raised by about 25%. Thus, the average retiree household income now is probably around $43,000 a year. In the upper end of incomes, we see that retiree households in the 9th decile made between $62,000 and $85,000 a year, and finally the highest earners made over $85,000 a year in income. This chart shows the makeup of people in the household, and the most common arrangements are single-person households at about 37% of respondents, followed by 31% of households that had two people in them that were 65 or older, probably married folks. Then they had a few other categories of household composition that you can pause and peruse if you so desire. Okay, now let's review the 6 main sources of income that households have. These charts are broken down into the 10 deciles of income. The first income source they identified is Social Security, and most of you understand what Social Security is, but for my international audience, it's basically retirement income for American workers, where you pay into it over time, and then when you retire, assuming you've contributed long enough, then you can get payouts from the government, though your payout is only loosely related to how much you put in. The Social Security chart has 10 rows in it, each of which represents a decile, which shows what percentage of that decile collects Social Security. So like about 60% of households in the lowest decile of income get Social Security, versus about 90% in the second decile, etc. Looking at this Social Security chart, you should be able to conclude that the vast majority of age 65 plus households receive Social Security, since all deciles are over 50%. The second source of income is Supplemental Security Income, or SSI, which is a government program that provides monthly payments to adults and children with a disability or blindness, and who have income and resources below specific financial limits. SSI payments are also made to people aged 65 and older without disabilities who meet the financial qualifications. Or to say that another way, SSI is for poor people and for some people with disabilities. In the SSI chart, we see that the lowest income decile are the ones who collect SSI more than any others. Which makes sense, i.e. the poorest seniors are most likely to have supplemental security income, and the more income people have, the less likely they are to have SSI. The third source of income that older folks have are pensions and retirement accounts, which include 401ks, 403bs, thrift savings plans, IRAs, life insurance contracts, and annuities. So dividends and retirement accounts fall into this bucket. Here you can see that the lowest decile of income households are least likely to have pensions or retirement accounts, and it visually looks like only 10% in that decile got any income from those sources. That implies that if you're someone who owns dividend stocks in your retirement account, then you're probably in the minority of people out there, so congrats. The fourth income source is property income, which obviously includes real estate rental income, but it interestingly also includes dividend income that you get from a taxable brokerage account. I guess they kind of look at it like if you own shares in a company that pays dividends, then it is equivalent to you owning property. The fifth income source they identified they called earnings, which is income coming from a job that either you or a significant other has, and which could be from working for someone else, or it could be income from being self-employed. And although the majority of 65-plus-year-olds are retired, about 20% of older adults still work and 16% live with someone else who works, and the survey concluded that over a third of older households receive at least some of their income from working. In this earnings chart, you can also see that the more income households are getting, i.e. the higher the deciles we go, the more likely it is that they're working, which makes sense. I mean, if you work, you tend to make more money. So like around 80% of households in the top decile that make over $85,000 a year of income had at least one 65-plus-year-old that was working. Finally, the sixth source of income they identified is a catch-all they called Other, which includes veterans payments, unemployment insurance, workers' comp, and income from friends and families and such. Here is that data all in one chart. It breaks down each decile of income, showing what percentage of their income they get from each source. All that green is Social Security, so you can see that for older folks, Social Security accounts for just over half of total income. Then earnings income is the second largest source at about 19% of total income, followed by pension and retirement account income at about 17% of total income. Okay, now let's dig into those sources of income a bit more. Here are the breakdowns of deciles across the different income sources. So like if we look in the middle at the fifth decile, we see that the average total amount of income for someone in that range is about 32 grand a year, and the average annual income for the sixth decile is 38 grand a year. Thus, my previous guess that the average retiree household income was at about 35 grand a year looks appropriate. We can also see that pension and retirement income in the fifth and sixth deciles averages 7 grand a year. Property income in those middle deciles averages about $2,100 a year. So if your taxable account dividends can grow to over $2,100 a year, then you'd already be doing better than the average 65-plus-year-old in that income source. I'm very confident that almost everyone watching this video will be able to do way better than $2,000 a year of quality dividends in a taxable account by the time they're 65 years old. I say quality because I don't want you chasing only high-yield stuff just to get a number. Okay, we also see that the average retiree gets to about 7 grand income a year from pension and retirement accounts, and about to 9 grand if you include a taxable account in there as well. But what would it take someone who had never invested, was 40 years old, and wanted to have 9 grand worth of buying power by the time they were 65 years old, adjusted for inflation? Well, my advice would be to first open a Roth account at Fidelity or E-Trade or any of the big brokers. A Roth is nice to get tax-free compounding for 25 years, i.e. from age 40 to 65, and for tax-free withdrawals in the future. Let's use my Portfolio Growth Simulator tool to estimate what the 40-year-old would need to do. Let's assume they had $1,000 to start investing, and let's assume that they invest in conservative quality dividend stocks that average a 3% starting yield and that have a 7% dividend CAGR. Let's also assume that inflation goes to 2% and that we see 5% share price appreciation per year over the decades. If $400 a month was invested into that portfolio, then in 25 years the buying power would be at about $10,000 in dividends a year, which would be more than the average retiree would be getting from pension, retirement accounts, and taxable accounts. Now, when I said quality dividend stocks, a good place is often Dividend Aristocrats and Kings, which are dividend stocks that have raised their dividends for at least 25 consecutive years and 50 consecutive years, respectively. An example of a dividend king is Procter & Gamble, ticker PG. Here's some information on Seeking Alpha about Procter & Gamble. As you can see, it says that as of today it has a 2.63% dividend yield and a 5-year dividend growth rate of 5.73%. You can also see that it has an amazing 66 consecutive years of dividend increases. Seeking Alpha is my favorite source for stock information on the web. It's not perfect and nothing is, but it tends to be better than most anything else out there. Anyways, it's super important that you invest, and there's a surprisingly simple 3-step plan to get wealthy. Note I said simple, not easy. And those steps are to number 1, work, number 2, live frugally, and number 3, invest. If you can do that going forward, I think it'll be hard to not end up in a great place once you're in your golden years. And passive income, from whatever source, is ideal when retired. Recall that we saw that the average retiree household is making 35 grand a year in income, with over 50% of that coming from Social Security. But many of those households required them to still be working at 65 plus, where they earned about 15% of their income from a job. Now, some jobs can be fun and that's great, but unfortunately some jobs are taken because the person has no other options to make ends meet. So even a small amount of recurring passive dividend income from a retirement account or a taxable account can be a game changer which snowballs over time. For reference, here are the median retirement account balances by age per a 2022 Vanguard report. So if you're less than 25 years old, the median retirement account is about $1,800. If you're 25 to 34, the median account has about $14,000 invested. 35 to 44 gets up to 36 grand invested. 45 to 54 takes you up to about 62 grand. 55 to 64-year-olds get up to almost 90 grand invested. And 65-plus-year-olds go down a bit as they've probably been selling some shares, and Vanguard found their median accounts to be about 88k invested. We saw that the middle decile 65-plus-year-old makes around $7,000 a year from pensions and retirement accounts. If we assume that 2k of that is from a pension, then an average retiree is making like 5 grand a year in their retirement account. That means that if you had an $88,000 account, you'd need to be at a 5.6% dividend yield to make that $5K a year. Or maybe you're at a 4% yield and you're selling some shares. But without investing, you'll either need to keep working in retirement, or you'll have to have a standard of living tied to your Social Security. So invest, and invest more, and your future gets brighter and brighter. But don't obsess or worry about your portfolio size. Don't freak out and try to force your returns, as that usually leads to problems. Just invest intelligently and manage your expenses, as controlling spending is half the battle. For reference, here is the average annual spending of retirees. About 60% of retirees spend less than $40,000 a year in retirement. Vanguard also found that the median participant investing rate in accounts was 6%, i.e. half the people invested more than 6% of their income and half did less. But start with what you can afford. Try to get your employer 401k match at a minimum, if they offer it. A good goal is to try to get to a point where you're investing 15% of your take-home pay. Do that and I'll bet you'll do better than 50% of the population. Vanguard has a free retirement income calculator that anyone can use to estimate how much money they may need after they retire. CNBC also has a good retirement calculator, and I'll include links to both of them. Now, a key benefit to retiring with dividends are psychological, not just financial. Like, I found that I had a much lower stress level when my investing strategy changed to buy and hold quality dividend companies as opposed to non-dividend companies. Immediately, my investments were productive, generating cash flow for me, rather than just sitting there. Plus, non-dividend investing approaches usually require you to sell your stocks, your principal, which slowly decreases your number of shares, all the while causing your stress to increase as you hope you won't run out of money. Retiring on the 4% rule would freak me out, and it would suck selling in down markets, and it would suck seeing your payouts fluctuate based on how the market was doing. And remember, the 4% rule suggests the total amount that a retiree should withdraw from retirement savings each year. The rule was created using historical data on stock and bond returns, but now some experts suggest 3% is a safer withdrawal rate, and knowing that the amount you're supposed to be selling was overstated would also be stressful. Like, are you burning down your principal too fast and you're going to run out of money? Us dividend investors can avoid most or all of that worry. And as markets fall, we dividend investors tend to keep getting steady payouts. We have confidence that our dividend hikes will grow faster than inflation. Quality keeps us solid and enables a retirement that feels magical. At least that's how it's been for me over the last 2.5 years, where dividends have been paying all my bills. Anyways, I hope that you now have a better understanding of what your retirement would be like with dividends versus without. Now, I'd normally call out my newest Patreon, Aristocrat, or King signups, but I'm currently all sold out. So instead I'll pitch my Seeking Alpha affiliate link in the description of this video, as well as in the pinned comment. Using it lets you try Seeking Alpha Premium for 14 days for free, and you can cancel it at any time during those 2 weeks, and then they charge you $239 for a year's access. I personally have paid $239 a year for premium access for multiple years, mostly because I value the articles and the comments section so much, to the point that I literally will never buy or sell a stock without first reading all that information. And double check what they're offering if you click on my link, because they change the sign-up deal every so often. Oh, and if you appreciate when I do free dividend investing videos like this, then please hit that thumbs up button, subscribe if you haven't yet, and then select all notifications so you're notified the next time I post a video. Finally, I highly recommend that you join my free Dividend Discord chat server, which has over 10,000 dividend investors on it from 72 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.